In this video, we're going to be looking at the valuation on the US equity market once again, looking at the implied discount rate and the equity risk premium. Then we're going to spend some time looking at the various recovery indicators around the world. So I want to start with just a quick discussion of valuations. Now, the US implied discount rate based on a dividend discount model is basically got the discount rate below 7%. So for the first time in the 35-year history of this particular series. So in absolute terms, certainly the US equity market is expensive. Of course, the other component, and this is where a lot of the debate on the valuation on the US market is focused, is the impact of the decline in the risk-free rate, the Treasury 10-year bond yield. So that there obviously has declined, excuse me, over the period as well, now sitting at around about 0.8, 0.9%. So obviously been a close relationship there. We might just add the Australian implied discount rate onto this chart while we're here, and you can show a very similar pattern, albeit slightly higher. So if we look at this in terms of an XY chart, you can see the tight relationship, 10-year bond on the bottom axis and the discount rate on the Y-axis. Interestingly, if we sort of look at the trajectory of this relationship over time, if we go back into the 1980s, we can see the relationship here between the two high levels of bond yields and very high implied discount rates. If we moved on then into the 1990s, you can see how it sort of gravitated down towards the middle parts of the chart, and then into the 2000s, a flatter line, not as close a relationship. Discount rate was low despite bond yields still being around 5 and 6% at one point. And then in the 2010s, we can see how it's a congregation of observations here at the lower reaches. So a tight relationship over time between the discount rate and the discount rate on equities and the underlying bond yield, as one would expect. So what if we then looked at the relationship between the discount rate and valuation? So we're going to now look at the 12-month change in the US equity market. And alongside that, we're going to look at the change in the discount rate on this chart. I'm just going to uncheck this. So what we're now looking at is the relationship between the performance of the equity market. So this is 50% increase up here on the Y scale, and this is a 12-month change in the discount rate. And the reason I'm doing this is to get a sense of the sensitivity at a very simple level of the sensitivity of the equity market performance to changes in the discount rate. In a way, it's perhaps saying something about the duration of the equity market. And so what that actually shows, and you can see the relationship here, the red dots are the most recent 3 or 4 observations, but basically the regression is this, suggesting a sensitivity or a coefficient sensitivity of around about 18. So for every 100 basis points change in the implied discount rate tends to add 18% to the valuation on the equity market. Obviously, there's volatility around that. So very simplistically, one might say, well, okay, does that mean if bond yields decline another 100 basis points from here, could we expect another 18% or 600 basis points on the S&P 500? And that would be if everything else stayed the same and the equity market responded to another decline in bond yields, albeit into negative territory. One would think not. However, but the Treasury bond yield, of course, is only one part of the discount rate. The rest of it is the equity risk premium. So very much a case of looking at the equity risk premium, which, as we said before, currently sitting up around about 6%. If we just update that for most recent data, currently sitting around 6%. So essentially what this would suggest is if you've got a 100 basis point decline in the equity risk premium, all other things being equal, it could potentially be associated with an 18% increase in the equity market. So that's the latest on valuations. What we also know that during recessions, although bond yields might decline in recessions, the discount rate tends to increase. And we have recessions here. So yes, so as we can see here, normally recessions are associated with declining bond yields, but they're also associated with rising equity risk premiums, and so that bears out here, where the discount rate actually increases during those periods, and also associated with declining in the equity market valuation. So we're going to now turn our attention to just a very quick look or survey of all our recovery charts, and I'm going to start with some market type indicators. Base metal prices have continued up, a slight setback over recent days and during parts of September, but broadly the trend seems to be still consistent with recovery. Iron ore has shown some softness since September. Likewise, Dow Jones Transport relative to market has gone sideways, and utilities have outperformed the overall market. Now, whether that's because prospects of a Biden victory coming up very soon, but nevertheless, what we're seeing here is a much more mixed bag in terms of market pricing or market indicators. Base metals still doing well, but iron ore not so, transport not so, and utilities typically wouldn't outperform in a recovering economic environment. And the other ones that we'd look at here would be particularly implied inflation expectations, and they've been rising since March. Obviously, a bit of a sideways move during September, but have returned to a slightly rising trend. So on balance, the market type indicators are still supporting the recovery thesis. What about the actual economic data in the US? We'll just look at a few of these. Retail sales. The way we're looking at these is to say, well, let's call end of January 100 and let's have a look at what's happened since. So retail sales in the US are about 6% above where they were in January. So that's a strong result. Auto sales are almost recovered all their lost ground. Consumer confidence hasn't. And likewise, payrolls haven't. Consumer confidence is still probably 10 to 15% below where it was in early this year, and payrolls are still around about 6% below pre-COVID levels. Looking at other areas, I think this is probably the key, is personal income. Personal income got the boost. It was something like 13% above pre-COVID levels in the initial stages of the stimulus package. With the stimulus package now wearing off, income now is about 3% above pre-COVID levels. So that's come back down to much more normal levels. And that is a concern, particularly when there's no agreement on further fiscal stimulus. In terms of the housing markets have done very well. The most interest rate sensitive sectors you would expect to do well. Home sales, whether new or existing, are up around about 20 to 25% on pre-COVID levels, and even starts are basically back in line with where they were. Just looking at some other areas, the builder confidence indices are 10 to 20% above previous pre-COVID levels. Freight indicators, which had tanked quite significantly in the early period, have basically recovered their lost ground by and large, as too has the ISM. If we look at just a couple of other areas, the small business confidence is basically showing a V-shaped recovery. Manufacturing orders, likewise. And earnings. It's interesting if we look at earnings on a quarterly basis using the S&P data, falling to $19.50 early in the year, recovering. These are the blue bars, the 32, and these are the projections. So the analysts have got quarterly earnings basically reaching pre-COVID levels in the second half of 2021. And then finally, there's the big concern about the recovery and the sustainability of the recovery, of course, is the increase in COVID cases in the US, which are now surpassed the sort of summer levels on a daily basis. And the stringency ratio, which is a measure of basically 8 or 9 different variables in terms of restrictions, has been slowly declining, but one suspects that that's going to tighten up a little bit and potentially undermine retail sales over the shorter term. If we now look at China, probably China's showing a better picture. Retail sales are almost back to where they were at the start of the year. In fact, on an annual basis, they're now positive. GDP is pretty much in line with where it was now, previous to COVID. Motor vehicle sales have recovered all their lost ground. Transport investment growth has recovered to previous levels, and particularly in the utilities space, investment has picked up quite strongly in China. Elsewhere, it's roughly back to where it was. So China's shown some probably the most promising recoveries. Electricity output is back above where it was. IP growth similar, and we talked about retail sales being quite solid. First positive or second, most encouraging result basically this year. Looking at Europe, where does Europe stand in terms of recovery indicators? PMIs have done very well, particularly manufacturing, but we noticed that the service sector numbers have dropped off. Motor vehicle sales have recovered, lost ground. Manufacturing orders likewise, and retail sales similar to that of the US and indeed Australia are above pre-COVID levels, supported by massive handouts. And but the more sort of forward-looking numbers around business confidence are starting to roll over, and this is where the concern is. The IFO out this week shows that the initial V-shaped recovery up until about July, August is just giving way to something much more vulnerable, and that shows at the overall level and then of course at the industry level here as well. Now, similar to that of the US, daily cases are rising quite sharply. If we look in the bottom right-hand chart here, cases, as you can see there, particularly in France, but also in the UK, rising very sharply. And that is leading then to another rise in the stringency indices for each of those countries after declining during the summer months. Being steady, we're now starting to see a retightening of restrictions, and that will curtail retail spending, one would think, over the next few months. We'll just finish up with some recovery indicators for Australia. Consumer sentiment is the standout. That is about 10% above pre-COVID levels, led by expectations around the next 5 years, which is up 20%, more than 20%. So that's been where the recovery has been the most. So longer term expectations have improved. The other indicators are sort of broadly in line with pre-COVID levels. Now, similar to the US, hours worked and payrolls or jobs, this is the weekly job survey, they're about 3 to 4% below pre-COVID levels, and hours worked around about 4%. So they haven't seen the recovery yet. We've probably regained about half of what was lost in the jobs market, but we're finding it much more difficult in the current phase of this recovery. Housing indicators, so similar to the US, housing finance has picked up quite strongly. It's about 10% above pre-COVID levels, being led by owner-occupiers, particularly in the areas of construction, which I think we should show here. Construction's up there, and then in this area, so this is construction here, showing it up about 20% in value and about 25% in the number. The NAB survey is also basically back to where it was. So the overall picture, I think, that we can get from this is that broadly the recovery indicators are still in place. Where we are seeing a little bit of a softening now in the last 1 or 2 months is in the service sectors in Europe. Particularly, we're likely to see an increase in restrictions in Europe and possibly the US, which will add to some weakness. We're seeing some mixed results in terms of market indicators, such as base metal prices doing quite well, but certain sector performance is painting a slightly different picture. So that is it for this week. Thank you for joining.